And welcome back. In today's video, I'm going to touch on some early indications of home buying demand, what could impact our housing market in the weeks and months ahead. And there's some very big changes occurring right now because have a look at this. The 10-year Treasury note is at 3.3%, a decrease of almost 3 basis points today, but a giant decrease compared to the highs we saw back in early March when the yield was at 4.07%. And also back in October 2022, the yield was 4.21%. I mention this because the yield on the 10-year US Treasury note mimics the rates we see for mortgage rates. So look at this. According to the Mortgage News Daily, as of today, which is the 5th of April, average 30-year fixed rate mortgages is at 6.16% for people with great credit, of course. 6.16%. For a 30-year FHA or VA, that's around 5.80%. Also, you can get a 15-year loan at 5.75%, which is more or less a 2-month low. Look at this, 6.16%, the lowest rates we've had going back to, wait for it, February 2nd this year when rates were at 5.99%. Therefore, average 30-year fixed rate mortgage rates are at a 2-month low. Of course, having said that, rates 1 year ago were at 5.02%. Therefore, rates have increased approximately 1 percentage point over the past 12 months. However, though, but look at this. Rates as of March 2nd, just 1 month ago, were at 7.10%. This means average rates have decreased approximately 1 percentage point over the last 30 days. And here's exactly how that's impacting home buyers right now. So here's a look at your average monthly housing payment based on principal and interest for someone looking to buy a $450,000 home, putting 5% down. Looking at their housing payment today versus 1 month ago when rates were averaging at 7.10%. So at 7.1%, again, the average from 1 month ago, approximately, your housing payment based on principal and interest would be just under $2,900 per month. However, though, fast forward to today, look at this. Average rate's 6.16%. Your new housing payment would be $2,607 per month. In other words, to buy that same $450,000 home 1 month ago compared to today, you're going to save approximately $266 per month to buy that same house. So that's number one. Number two is, given the fact that rates have decreased approximately 1 percentage point over the last 1 month, that actually increases buyers' purchasing power by about 10%. And also number three, take a look at this, because for rates at 6.16%, your total interest paid over the life of the loan, again, 30 years, your interest paid over the life of the loan would be $511,000, I can see right there. But at 7.10%, your interest paid over the life of the loan would be just under $610,000. Therefore, because rates have decreased from 7.1% down to 6.16% over the life of the loan, you're going to save approximately $100,000. Now, I'd love to hear from you guys regarding this. Do you guys think that because rates have decreased to 6.2% more or less, do you guys think that's going to be impacting home buying demand, or therefore is it going to be increasing home buying demand in the weeks ahead? Please comment below. Here's something else you guys should be aware of as well, is that even though rates have been decreasing to more or less a 2-month low, applications for home loans actually decreased last week. This is according to the MBA, which is just posted today at the time of this video for the week ended March 31st this year. So applications for refis decreased by 5% compared to the previous week, and of course was down 59% from 1 year ago. Also, despite the fact that rates have been decreasing, applications for home loans to buy houses actually decreased by 4% compared to 1 week ago, and also is down by 35% compared to the same week 1 year ago. And this actually is a new trend because as I've been reporting to you guys, applications for home loans to buy houses were increasing for 4 consecutive weeks. So this is actually the first time in the last 5 weeks in which applications actually decreased. Here's another way to look at their purchase index over time. Here's our index actually over the past 1 year. So for the week ended February 27th, their index was at 138.8, the lowest levels in at least the last 20 years. So applications increased for 4 consecutive weeks after that, but last week they actually decreased. In fact, when we broaden this to 2015, the current levels right now are more or less on par with October of 2015. In other words, even though applications for home loans had increased for 4 consecutive weeks, mortgage demand still remains at very low levels. And going back to the MBA's report here, it says spring has arrived, but the housing market is missing the customary burst in new listings and purchase activity that typically mark the season. After 4 weeks of increasing purchase application activity, volume decreased a bit this week, even with another small drop in rates. Additionally, refi application volume continues to be quite low, again down by 59% from 1 year ago, although the mortgage rate for conforming loan balance loans declined by 5 basis points over the week to 6.40%. The mortgage rate for jumbo loans, that's high balance loans, actually increased by 9 basis points to 6.36%. So for loans for conforming loan balances, that's not a jumbo loan, rates actually decreased by 5 basis points, whereas jumbo loans actually increased by 9 basis points. And it says here, this divergence in rates suggests that banks may be tightening credit in response to recent challenges by the fallout of Silicon Valley Bank and of course Signature Bank as well, preserving balance sheet capacity as deposit balances have declined. So what this means is that they're suggesting that because rates for jumbo loans increase, yet conforming loan balances or rates on conforming loans actually decrease, that could imply that lenders are tightening their credit for high balance loans or jumbo loans. So take a look at this. Here's average rates according to the MBA. Average rates as of the week ended March 8th were at 6.79%. And now for April 5th, they're down to 6.40%. So rates have decreased approximately 40 basis points ever since the beginning of March this year. That's for 30-year conforming loan balances. Here is jumbo loan balances though. Look at this. So on March 8th, rates are at 6.49%. Now they're at 6.36%, a small decrease from the highs we saw back in early March. The reason why I'm sharing this is that this could impact, or if this trend continues, this could impact the luxury home market. So markets in which home prices are above conforming loan balances could be impacted by these rising rates here. Whereas rates for conforming loan balances are decreasing, again, jumbo loans are actually increasing. Again, this is a very, very short-term trend, and I'll definitely keep you posted. So going back to some early signs of home buying activity, according to the National Association of Realtors, based on their foot traffic report for February, on a national level, home showings decreased by 14% compared to February of 2022. Showings decreased in every region as well. The Northeast fell by 14%, the Midwest down by 12%, the West declined by 19%, and the South experienced a decrease of 11%. So home showings by real estate agents showing their houses to home buyers are down by double digits on a national level and also down by double digits in each of the 4 major regions. In regards to home showings, here's another report I like to share as well. This is on showingtime.com. This is a look at home showings in 2023, this year in orange. The line above there is 2022, and the line at the top here is for 2021. And this is based on a 7-day rolling average compared to the first week each year here. So for example, for the week ended April 4th, home showings increased by 20.8% compared to the first week this year. Last year, it was a 25.8% increase compared to the first week of 2022, whereas in 2021, it increased by 24% from the start of that year. So what really caught my attention regarding this is that home showings are still down compared to the past couple of years, which makes sense given the fact that rates in 2021 were at 3% on average for the entire year. And of course, in 2022, rates were much lower than they are today, about 1% percentage difference. But the home showings this year are not too much far off 2022's levels. They are still below the past couple of years, ever since the end of February here. But remarkable to see that home showings have not decreased as much as previous years. Now, of course, I have to give you guys my disclaimer here is that even though home showings have increased by about 21% compared to the start of this year, this does not mean that's going to translate into more offers or more closed home sales in the weeks and months ahead. Here's something else I also look at as well when I'm talking about some early indications of home buying demand. It's not perfect science here, but this one of the trends I actually look at here. So here's a look at Google searches for homes for sale. So the current levels right now are actually about 14% below 1 year ago. So the interest over time for homes for sale is down approximately 14% on a year-over-year basis. On top of that, searches for homes for sale have been more or less flat all year. And lastly, here's a look at pending home sales according to Redfin and compared to 2021 and 2022. The black line is 2022, the orange line is 2021. So for the week ended March 26, pending home sales were down by 19.2% compared to the same time frame in 2022. And there's two things I want to mention regarding this. This 19.2% year-over-year decrease is actually the biggest decline going back to right here, January 29th this year. So in other words, the year-over-year difference in contracts being signed between buyers and sellers is a 2-month low right now. And lastly, the number of contracts being signed between buyers and sellers has been increasing this year, just like it has in previous years. But over the past couple of months here, or past month or so, the current levels have been more or less flattening out. So in other words, we are seeing this kind of a seasonal uptick in contracts being signed, but the current levels right now have been flattening out over the past month or so, and also are still well below the past couple of years. And with that said, please comment below with your biggest takeaways from today's video. Also, if you guys got any value in this video whatsoever, then please hit the like button. We appreciate that. Of course, I appreciate you. Hope you guys have an awesome day. Look forward to seeing you on the next video.